Howdy, Jacob here. Today we're looking at Crowdstrike Holdings. Been in flame the last month or so. I believe a month ago, there was some large hits on a lot of companies that use Crowdstrike. I think if anything, that just means that it's as important as ever to use a cloud computing cybersecurity solutions company. And I mean, CrowdStrike's definitely up there. I think it's the second most well known, or top two most well known. The only one I could think of that could be more popular is Palo Alto. But I mean, cybersecurity is not going anywhere. I've listened to so many AI talks, and it seems like, with AI becoming more powerful, it just means greater security needs to be had and greater, not just security, but greater knowledge to individuals, since the first line of defense against cybersecurity is yourself. Obviously, solutions can help, minimize some of the risks to your company, or if you're self-proclaimed to yourself. But I mean, it's gonna hinder you from doing some things, but really, the first line of defense has to be yourself. Either way, I think that this industry has just massive growth ahead of them. I don't see it slowing down anytime soon, and so this might definitely be one of the larger growing companies from my perspective of the period of time that I'm looking at. So we do see revenue is increasing very impressively year over year, but the revenue growth is going down year over year. So it was 125% year over year in 2018 to 36% in 2024. Again, makes a whole lot of sense because business is growing. Once it's as big as it is, it's harder to grow more from that. When you're growing from zero to hero, it's easy to double every year. But then once you actually secure a good amount of revenue, it's going to be tough to find extra companies to use your products or your services. And so their revenue increasing less makes a whole lot of sense to me, but we do see some positives. So they're almost at an operating margin. Their gross margin has gone up to 75%. Very awesome. Return on invested capital, essentially nothing because they don't make any money from the income side, I want to say. So R&D has gone up immensely. They cut that R&D in half, 400, maybe 300 post taxes. You're looking at 10%. So not a super impressive net income, but they're still investing a lot in growth. And so I'm still not surprised that that income margin is a little bit lower. Their balance sheet, come on, let's go to the balance sheet. So 58.6 market cap, 55.7 enterprise value means they have a whole lot of net cash. And darn, do we see that. 742 million long-term debt, no short-term debt, with almost $5 billion in cash-like products. So way more than enough cash to write off that long-term debt. Not concerned with the balance sheet whatsoever. It's going to make it a safer investment from the standpoint of them going under. But again, a safe investment also deals with making money. And it looks like on the free cash flow side, they definitely make money. Where they might have a little bit of problems, not problems, but where they're making a lot of their money on the free cash flow side is stock-based compensation. So they're issuing options to their big dogs of the company, and depending on how well the stock does, may go through or not. And so they are really increasing that stock-based compensation, and their use of cash is really just increasing their cash amount, making acquisitions, and reinvesting back in themselves. They're not buying back any shares to offset the options, and they're definitely not paying a dividend, and they have little debt, so we're not terribly concerned about that. So I think we're ready to make some assumptions here. On the revenue growth side, I mean, I think they can grow 15% a year for the next 7 years, kind of all day. I think that 1% of shares, 600 million, they're going to increase shares about 1% a year. As for margins, we're going to do a big range here. They're already at 30% for margins. I think that I'm probably comfortable going 30, and then maybe, let's say they get to net income side closer to free cash flow by the end of 7 years. maybe that's not true, but I think that's a possibility. And I think that there's still going to be a lot of cybersecurity capabilities for growth at the end of this period. So maybe even a 25 PE price to free cash flow. So this is where I get a little bit unsure in these companies that have grown 100% down to 35%. Even the last year of 36% is still absolutely immense. Maybe my 15% a year is very lackluster and it's too conservative. But to me, as the investor that I am, I'm not gonna reach for numbers and create a story beyond what I think is the most likely outcome, most probable outcome. So to me, I think that I do feel comfortable with these assumptions. And even with them, you need to fall 67% before you get the return we're looking for here. So I will be reviewing other companies, but I think, fantastic company. It's been through some stuff in the last month. If it really gets hit a lot more, I think I'd definitely start doing a deeper dive in it, because I think this could be a company that easily grows 25% a year. I mean, not easily, but I think they easily could with their reinvestment capabilities and acquisition use of free cash flow. And so for me right now, though, based on what I'm saying, I'm just going to be waiting. But I hope you enjoy the video and have a great rest of your day. Thank you.